Well, good morning. Thank you to everyone who has turned up today in what's been a pretty remarkable week for financial markets, one that many of us are not going to go and forget in a while. Probably could have been a lot more volatile, if I'm being honest. But that being said, there was still a lot of trading opportunities out there and a lot of wild price action, which I suspect is probably going to die down a little bit in the week ahead. Before we go and kick off, I will get you to go and look at the risk warning on your screen. Remind you this is general advice only, and do remind you as well that you can go and ask questions through the platform, but just remember everything is general advice in nature. You're choosing to go and participate, and the views are mine and not of City Index. Well, what a week. I hope you're feeling more energetic than I. It's been pretty big. Of course, culminating with the federal election in the United States, and then, of course, the other Fed meeting earlier on this morning, our time in Asia. Really, really big events. And now that they've passed, they've given us some clarity as to what we can go and expect moving forward. And that's excellent when it comes to trading, because not only do I expect we might go and see a continuation of some of the trends that have come out of those two events, but also swing opportunities. Now that this uncertainty has been resolved somewhat, it should go and create opportunities to go and look for our tops and bottoms and have more confidence that they'll go and stick. I'll start off having a look at the Fed meeting, because that's been really influential today when it comes to what's going on with the interest rate outlook moving forward. So let's get straight into it. Just going to get up on my screen. There we go. So this is the statement that was released by the Fed this morning. There wasn't a lot of changes. There was no economic projections or forecasts that were updated at this meeting. That will arrive in mid-December. But I've just gone and highlighted one of the lines that are pretty important right now. And that was just saying that inflation has made progress toward the committee's 2% objective, but remains somewhat elevated. Now, most of that's almost identical, but there's one missing word, and it was inflation has made further progress. That was what was released in September. So just a really sequential change, a nuanced change. It just suggests that maybe progress in getting underlying core PCE inflation back to its target has maybe stalled. That's not the way it was sold by Jerome Powell in the press conference, but that's the way it kind of implies. And there wasn't a lot of other changes in the statement, it's got to be said, because of course 25 basis point cut coming through. But looking here, the committee judges the risk to achieving its employment and inflation goals are roughly in balance. So they said that they're potentially not making the same progress in getting inflation back to their inflation goal, and that they see that risks are evenly balanced. And then they also say that the economic outlook is uncertain. Now, when you go and put that all together and exclude Jerome Powell's press conference's views of just one individual, and often he speaks to kind of his view rather than the broader committee, is the sense that I get. When it's uncertain, when risks are to either direction, you tend to sit back and wait. And I would not be surprised in the slightest if the Fed is trying to go and sow the seeds potentially that they might go and pause when they next meet in December. Of course, a lot will come down to the economic data that we'll go and get between then. But right now, it just looks like the Fed is trying to go and anticipate that the data is very strong right now. And of course, the election outcome and the prospect of fiscal stimulus in the United States, they've got to start considering that as well, because monetary policy works with quite a significant lag, especially in the United States, given the structure of their mortgage market. Here's a really interesting chart. A few of you might have seen it before. This is Citigroup's Economic Surprise Index. So basically what it looks at is economic data, how it comes in relative to market forecasts. In the top pane, you can see in red is the United States economic data, blue is in the Eurozone, and grey is for China. And it goes back over the course of a year or so, and you can see right now, for the first time in quite a while, we've got all three of the biggest economies or economic blocks in the world are now seeing data surprises more often than not on the upside rather than downside. And that's taken a little bit of the heat out of the US dollar. Of course, it was on a rampage over the past couple of months, but just this turning point, and the bar for data surprises, got to be said, in Eurozone and China is much lower than the United States. But right now we've seen that go and tick high into positive territory. It's not enough to go and lead to an outright reversal of dollar strength, in my opinion, but what right now, it balances out the directional risk for the dollar. Yes, it's had a very, very strong run. Yes, we know there's likely to be a lot of fiscal stimulus coming down the pipeline, potentially in the years ahead. But here and now, it's no longer looking like the exceptional economy out there. There are signs that potentially things are starting to go and turn in the Eurozone, and importantly, in China, because for us here in Asia, we know that that's much more important when it comes to the performance of a lot of our financial markets. One thing the Fed has to go and consider as well at this point in time is what the market is saying in relation to the inflation outlook. Now, this is market expectations. This is called 10-year inflation break-evens. What does that mean in layman's terms? Well, it means that this is what the market expects the average annual inflation rate to sit at over the next decade. And right now, it's sitting at 2.4%, give or take a few basis points. And whilst that's not rollicking away, it is a long way away from the Fed inflation target, which I've gone and indicated below in the solid red line. You can see pretty much since the Fed cut by 50 basis points in September, that has been absolutely roaring higher. And I just pointed out on that particular graph, the Fed weren't talking about cutting rates when inflation expectations were this high. And now, looking at what's going on with the economic data out there, maybe some uncertainty as to exactly where we sit when it comes to the level of the Fed funds rate, where it starts to go and stimulate activity rather than go and detract from it. This is all feeding into that view that potentially the Fed might have to go and pause a little bit moving forward, potentially starting in December. Market thinks so too. So what we're looking at here is the Fed funds curve between set dates, and it basically gives us a kind of a primer, a read as to what market expectations are for the amount of easing. In this case, the Fed is likely to go and deliver between 2 points. In the left-hand pane, you can see right now is basically the pricing for the Fed meeting in December. And you can see back towards the middle of September, there was more, just a little bit more than one full 25 basis point rate cut priced in. Now it's a lot more evenly balanced. It's sitting at around about 14 basis points. And you go look at other markets out there, which we'll have a quick look at in a moment as well, a little bit more. But it's not the slam dunk, yep, the Fed's going to go and cut again, probability that we saw with this meeting and what we saw with the Fed's 50-point move a couple of months ago. And then when you look at the right-hand pane here, this is Fed easing expectations from now until the end of next year. And you can see here, part of it is because of markets starting to anticipate Trump policies coming through now that he's been elected, but you now have less than 4 25 basis point rate cuts being priced over that particular period of time. If you go back to 2 months ago, the markets were looking at nearly 8. So it's been a big upward adjustment that's come through at this particular point in time. And so the markets can go and smell that the Fed is likely to have to go and start slowing the pace of rate cuts coming through. And that is starting to go and filter through when it comes to expectations throughout the curve. That's my neighbour's dog in the background who's yapping away, always at the most inappropriate time. Just to go and reinforce this point, so this is a different set of market pricing, and this comes to us from a Bloomberg screenshot. And what you can see here, you can see the hikes cuts column, it's in a yellow kind of font. That's the number of 25 basis point rate cuts that are priced in. You can see here, there's a little bit more priced into the OIS curve for the Fed's December meeting. 71% probability of a 25 basis point cut. But you can see here, again, much like what the cash rate of the Fed funds futures are, indicating, less than 4 full rate cuts right now. And when you look at the chart previously, it's pretty obvious right now that what we're looking at is a return to an environment where the Fed may be skipping meetings rather than being active at meetings that come up on the horizon. Just on Powell as well, one thing that came across earlier today, he was talking in his press conference about how slowing the pace of rate cuts coming through. And he said that it was just a scenario that was beginning to be discussed by the FOMC. But Powell, in my opinion, and a lot of others actually out there as well, leans more dovish than the central member of the FOMC when it comes to their bias on the outlook for inflation and interest rates. And you've just got to remember back to December last year. Early December last year, Jerome Powell was asked at an event, are you considering cutting rates at some point next year? And his answer was no, we're not even talking about it. Then about 2 weeks later, the Fed meeting came up and the Fed signaled 3 rate cuts. So he can turn on a dime. And the fact that he mentioned that today in the press conference tells me that maybe some of the market participants in that FOMC meeting room are already starting to go and get a bit uneasy about what they're seeing with the economic data coming through and the prospect of what fiscal policy might be implemented in the United States next year, and are keen to go and pause. So one thing to go and note, and I'll discuss this later on in the webinar, is that there's going to be a lot of Fed speakers now that the Fed meeting is over. So take really, really close attention to what they say over the coming week. One thing I want to have a quick look at as well is the RBA statement for us here in Australia, because it's really interesting what's going on in that front as well. Here's the statement that was released on Tuesday this week. Let me go and increase it a little bit. Reading through this, it tells me a central bank that is in no way near keen to go and cut rates anytime soon. And I wish for a lot of mortgage holders out there right now in particular who are doing it tough, but the RBA are very, very hawkish tinge to this statement. I'm just going to go and look at some of the areas why. So immediately, the headline up here, this sets the tone for the entire statement. And so when you're looking at statements in the future, look at these ones, because if there's any major deviation, you can get a really quick sense as to what there's been a change in particular view. But what I want to go and say, and have a quick look here. So it goes like growth in outlook has been weak, but then it refers to past declines in real disposable income. So disposable income now is positive. That's a tailwind potentially coming through when it comes to spending, consumption and the like. And that's largely reflects what's been going on when it comes to tax relief that was delivered in the middle of the year. And then you can see that growth in aggregate demand, which includes spending by temporary visits, has remained more resilient. So what they're basically saying at the moment is that still, even though the economy is really sluggish, demand is still exceeding what the economy can supply. And that's keeping inflationary pressures pretty resilient right now. And then you talk about the labour market, which is really the key piece of the puzzle when it comes to giving the RBA confidence to go and start slashing interest rates. Labour market conditions remain tight. Employment grew strongly. That was a hotter word, a more strong word than what was used in the previous statement. You can see participation rate remains at record highs. Vacancy still elevated, all at a time when unemployment rate is sitting at 4.1%, which is 0.2 below where it saw it at the end of this year. It can still get there, of course, but right now it's looking very, very strong. And that's even with participation at record levels. If that was to go and drop away a little bit, unemployment would decline if we can keep up the same kind of pace of hiring that we've seen recently. Again, labour productivity, this is the big kicker. They need to go and see the economy being able to go and produce more, the supply side, to go and suffice that demand. Still at 2016 levels. Not a change to the statement, but just a reminder that it's not seen any real evidence at the moment of a sustained pickup on that particular front. And then it goes through the rest of the statement, but the fact that it's talking about those things there the labour market in particular, it can't have confidence that with inflation still very, very sticky, particularly underlying inflation, which is putting a lot more weight on, remaining well above target, it cannot afford to go and cut rates. So you can see here, it remains too high. Underlying inflation is more indicative of inflation momentum, and it remains too high. Still some time yet before it's sustainably in the target zone. Remain vigilant to upside risks for inflation and not ruling anything in or out. So again, at the end of the statement, it adds this bit, which to me is, when this gets removed, it'll be a pure neutral statement, and the RBA will be essentially, to me, signalling that the next move will be down. Do what is necessary to achieve that outcome. When it's talking about not ruling anything or out, that's saying that it will still be prepared to go and hike against the grain of what other central banks are doing. And when you go and look at what's been happening with Australian OIS curve, so what the RBA is expected to do amongst market participants, take a look at the cuts that are priced into the curve right now. There's almost nothing for the December meeting. It would take something pretty horrific offshore, I'd imagine, to go and get the RBA to go and consider cutting at some point this year. And we don't even have a full rate cut priced now until May of next year. And only 2 are priced over the remaining time out to the end of 2025. So very, very slow. And the trend with this has been to go and continually push back against rate cut expectations. And even today, TD Securities came out, one of the forecasters here, and it's now gone and moved its first rate cut call for the RBA out to August of next year. So you can see where the trend is going at this particular moment in time. As a reminder, anyone here, if listening in, would like to go and ask a question, please do so. Shoot it through on the chat, and I'll endeavour to go and cover that off at the end of the presentation. Let's go and have a look at the week ahead. And I think probably for a few of us out here, I know the way that I'm looking at it, I'm quite glad that it's going to be a quieter week coming up when it comes to the macro front. This is from TradingView, and what I've basically done is I've narrowed it down to some of the key economies that are likely to go and really move financial markets one way or another. Veterans Day is something to go and note on Monday. There's nothing else to really go and consider. Even the BOJ summary of the opinions at this point in time, I'm not really that interested now, given the change that we've seen in the US presidential election. Veterans Day, stock markets are open, bond markets are not. So keep that in mind. And it's only a rule of thumb that kind of like sits in my head. I'd have to go back and actually do some back testing, but I generally see that a lot of the time when we have a public holiday where the bond market is shut, just gets this feeling that risk seems to rally. I might go and look into that for you in the near future and go and maybe put it up on social media. Like so many other weeks, what we're seeing is the bigger events go and come through next week towards the back end of the week. Anything I mention is what I think is going to go and potentially go and have some volatility around markets. Anything I skip over, it's me just saying I don't think it's going to go and be meaningful for markets. So if you see things up there and I just skip over it, that's the reason why. In the United Kingdom, the claimant count and employment change are just way too volatile. Payrolls as well. A lot of the response rates coming through are very difficult for the bank, the BOE, to go and consider. So it's the average earnings figure that is going to be most important. Filters through to expectations for services inflation, and then how the BOE may proceed from here, of course, after cutting rates last night. Moving forward, you can see here, unemployment rate again, experimental series, hasn't been around long enough. You can't go and put a lot of weight on that. And I don't think the markets would either. Secondary data in the United States, plenty of Fed speakers to go and listen to and see whether they're going to match the kind of dovish tinge that Jerome Powell continues to run with. I think that we might hear a little bit more hawkish language and potential to go and skip the December meeting, depending on incoming data. And then you can see here in Australia, the wage price index hasn't been a market mover for a long period of time. But when you're talking about labour market conditions filtering through to wage demands, filtering through to the inflation outlook, you can't go and overlook it. So that comes out on Wednesday at 11:30. This is all times in Sydney, Australian Eastern Daylight Time. That's one to go and watch. If there's a big deviation, it could really go and meaningfully change that RBA interest rate outlook. Then it starts getting interesting. The China data, it says it's coming out on Wednesday. It can come out at any time during the week. but that's going to be an important one. Total social financing is the big number to go and look at. That's broader financing, equity raises, bond market issuance, and the like. Is there any sign that the traction is coming through after all the stimulus measures have been implemented by China, that we're seeing anything come through when it comes to increasing, boosting borrowing demand? If it's not, then Chinese policymakers maybe will come out today, have to go and consider something else other than monetary policy to go and get things moving. So keep a close eye on that one as well. There is some important Chinese data coming out as well later on in the week. And you can see here on Wednesday in the States, it'll be Thursday morning, very early in the morning in Australia, late evening in Asia. You can see here the CPI reading in the United States. Core reading is the key one to keep a close eye on. We've seen upside surprises in the past two releases coming through. And you can see here market expectations early on are for a 0.3% increase. If you annualize that out, that's way above the Fed's target, 3.6%. And you can imagine that, yes, it's not the preferred inflation measure that the Fed looks at from an underlying perspective, but that's not compatible with their inflation goal at this point in time. So if it prints like that, yeah, it's going to go and add to that kind of belief that, hey, the Fed can go and afford to go and pause given some of the really strong momentum we're seeing in the economy right now. Again, a lot more Fed speakers coming up as well. You can see here in Australia, the other big event, the employment data out on Thursday morning, our time in Australia. You can see here, lots of focus, there's lots of moving parts, and it's a really, really volatile release for anyone who's traded around it in the past. But just a reminder, it really comes down to the unemployment rate that the RBA is focused on, because you can get lots of volatility around the participation rate in terms of the shift between full and part-time hiring, but it's really the unemployment rate, which is a much more steady, and the RBA in the past has gone and said it's a better indication of what's going on when it comes to labour market conditions. That's the one to go and focus on. And interestingly as well, at a press conference earlier this week when Michelle Bullock, the RBA governor, was speaking, she was talking about, and it's also in the statement as well, some of the other indicators, more cyclical indicators, like underemployment, underutilisation, and youth unemployment. They've all been rolling over recently. If that trend continues, you can forget about the RBA cutting rates anytime soon. It shows that what potentially we're looking at is the economy is still operating above its potential, and then that means that we're seeing absorption of any spare capacity in the labour market. So keep a close eye on that one. UK GDP, maybe. I don't think it's going to go and be the really big market mover. I haven't seen a lot of movement, even with the Eurozone figures that came out last week as well. You can see here some data coming out, the second estimates for the Euro area on Thursday evening, our time. In the States, then we get the second kind of big releases coming up next week, the core PPI report. And then you can take the CPI data from the session before and the PPI report, and then the markets have become very, very good at mapping the detail, the componentry in those reports to go and get a really strong sense as to how the core PCE deflator, which is the Fed's preferred underlying inflation measure, will go and print later on in the month. So after those two reports have been released, we'll have a much better indication as to the inflation outlook and potentially how the Fed might proceed. Of course, we've still got to get through the payrolls report at the start of December, but if that too remains pretty strong, the Fed is going to have a difficult task to go and convince markets there's a need to go and continue cutting interest rates. Just looking forward really quickly as well, again, in Japan, it's not likely to be a market mover. It's generally BOJ commentary that really gets things moving when it comes to dollar yen and the like, in the Asian time zone at least. And you can see here, like there's going to be expectation here that we'll see a modest increase in growth on the back of a 0.8%. A lot of the information received in this is kind of initial. It's not solidified right yet. And so it can go and change quite a bit. So I don't think it's going to be a market mover. You can see here on Friday, our time in Asia, bigger releases, house price index. Is there any sign that measures to go and boost the housing market are starting to go and show through? I doubt there'll be any cut to the MLF, which is a wholesale interest rate that banks go and use for funding that's already been cut quite a lot over the course of this year, including recently, and then the data dump arrives. So it's going to be a pretty important day on Friday to go and assess how the Chinese economy is going right now. And then just moving forward, the other big release to go and consider is going to be on Friday evening, Saturday morning, our time in Australia, the retail sales report. I think everyone's been astonished at the strength of how good retail sales have been in the United States, and it's really been responsible for powering the economy around. And so keep a close eye on that one. That's going to be fairly important coming through. So, what are we looking at here? Playbook for the week ahead. We've got basically buy dips in risk assets. We have likelihood, for me at least, that we might have seen the near-term high in yields. And then if that's correct, it also probably implies that we've seen the near-term high for the US dollar. And I'll just get to some charts towards the end to go and just underline that point. The positivity around the election, yes, you could say it's priced in and the like, but to me, it has likely to remain in place. And when you talk about other things at the moment as well, watch for the Fed speakers. Will they be still talking about cutting rates, or will there be more commentary about potential skipping? That's what I'm looking for this week. I don't think it's going to be as dovish as the way Jerome Powell kind of sold it earlier on today. Today's China stimulus announcement, whenever it arrives, is pretty important when it comes to cyclical assets, Aussie dollar, commodities and the like, Chinese equities in particular. So keep a close eye as to what we see later on today. It likely will go and extend into the new week. And yeah, zoom out to uncover longer term directional trends. What do I mean by that? Well, instead of focusing on some of the price action we've seen this week, which has been incredibly whippy and often difficult to go and decipher, and a lot of false signals, it's got to be said, I'm looking at weekly charts right now to go and kind of settle things down and then get a sense as to where the directional risk lie on a kind of medium to longer term. And just looking at some of the details out there this morning, I think it's a much better way when you're talking about setups, when you're talking about whether you want to go in favour buying dips or breaks or selling rips or breaks. To me, that is going to be a pretty good way to go and handle things. Just on the dollar and the rates, because we know how important it is at the moment, it really comes down to what happens with those markets. Let me just go bring up, first of all, what's been going on when it comes to the US Treasury market. You can see here on the screen, we've got 2-year yields on the left-hand pane, 10-year yields on the right-hand pane, and 30-year yields here on the right. And you can see this down the bottom pane, this is the change over the past 24 hours or so. Whilst we've had a big increase coming through, particularly at the back end of the curve, 30 years, 10 years, you can see that we're off the highs at the moment. A lot of people have been buying into the sell that we saw. And whilst there's still the threat that we're posed by really, really expansionary fiscal policies and whether there might be some inclination not to go and buy because of the implications when it comes to growth and inflation and the like, right now there's evidence that there's demand for treasuries, particularly out the curve. So that's important when you talk about what's going on with the dollar index. So left-hand pane, just looking at the daily chart of the DXY, we've got movements here in 2, 5 and 10-year treasury yields, and just reinforcing that point as well, that the dollar index, you can see here, this is pricing for Fed funds expectations, how many rate cuts will be priced in over the next year. Not extremely strong correlations, particularly to what we've seen in the past, but you can see here still when we see that yields typically go and rise, often the USD does as well. But in terms of at the moment, if we see that yields start to go and edge lower, we're likely to go and see potential for the DXY as well. I have a question come through. Just give me a second here. As a reminder, this is all general advice in nature. Yes, I entirely agree that China policymakers wanted to go and see who would win the US presidential election. We know that the threat posed by Trump's tariffs, 60% that's been slated by him prior to the election, that will be staggered in over 3 years. That's a big threat considering that the United States is the biggest trade partner for China. So actually, I know a very big trade partner. I think the Euro area still has that title ever so marginally. So yeah, they have waited, and in terms of they get incrementally, I'm not expecting kind of like a flood-like stimulus that we saw back in 2008 and 2009, but incrementally, the greater the risk becomes, the greater the likelihood that the policymakers, the Politburo in China will look to go and increase the amount. So yes, the fact that Donald Trump has been re-elected in the United States right now does increase the likelihood that we'll see a bigger package today. There were some rumours that came around late in the afternoon in Asian trade that talking about a 12 trillion yuan package coming through, which is big, very big, as big in terms of the monetary size as what we saw during the GFC. Of course, the Chinese economy, though, now is a lot bigger in scale. So keep a close eye on that particular announcement, and it'll be very, very good if we do get that coming through. The risk is, though, that what we've seen so many times recently, that if we don't get the 12 trillion yuan figure, we don't get any direct measures to boost consumption, we'll see a lot of the rally that we saw yesterday unwind. Well, with much further ado, we've been going for 30 minutes, and unless you've got any other questions coming through, we might go and wrap it up. As a reminder, here's the disclaimer, again, just reinforcing everything today, my views, general advice in nature. And anyone who is listening in, hope you had a fantastic week. Enjoy your weekend, enjoy your rest, and we'll be back to do it all again next week. See you then.